Good afternoon, everyone. My name is David Hernandez, and I am your guys' account executive with High Tech Lending. And welcome to this training webinar. And I'm excited that your office will be adding another product that you can now offer to your seniors, which is the reverse mortgage. It is an awesome program that will allow you guys to build more business and make a lot of money. So please feel free to stop me at any time through this presentation and ask me any questions you guys would like to ask. The more you ask, the more you know. So let's get right into this. Now, so today, here's what we're going to cover. Why reverse mortgage, the baby boomers, explaining the reverse mortgage, the common myths about the reverse mortgage, what programs are available, what out-of-pocket costs to the borrowers, and how to qualify your borrowers. Now, here's just a quick background about myself. I am a former reverse mortgage loan officer. I've worked in the mortgage industry for over 3 decades, which include foreclosures, bankruptcies. I was an REO asset manager, and I am a licensed real estate agent since 2001. And I have personally helped out hundreds of thousands of seniors on the reverse mortgage. Now, when it comes to being a reverse mortgage loan officer, there is really no experience necessary because I am your wingman. I will help you with all your clients from the beginning to the end. You guys will never be alone. I will not just educate you guys, but give you the tools you need to be able to explain the program. And together, we will work to find the best scenario for your clients. Now, we will draw all the disclosures in your guys' company name. We will do the processing. We will do the underwriting. We will do the funding of the loans. So, I mean, it's really easy. So we'll do all the work and you guys can continue focusing on new business. Now, clients have asked me, why does the government insure the program? Well, in 1988, Ronald Reagan signed the reverse mortgage bill into law to help seniors to be able to retire and stay in their home. Since Social Security really is not enough to live off of, most are still looking to refinance to get cash out, but don't really qualify for traditional loans due to DTI requirement. And with inflation where it's at right now, seniors need to access out their home, to get more money out. That's where the reverse mortgage allows them to do that. So just a little background about where it really came from. Now, let's talk about the baby boomers that were born between 1946 and 1964. And I actually found out the reason they called them baby boomers was that after World War II ended, there was like a spike of people having babies. So, which I thought it was interesting, but I'm very glad that they did because 11,000 of them are actually turning 62 every day. So on an average of 30 days in a month, that's over 330,000 new leads per month. And 25 million seniors rely on Social Security, about 90% of their income. And with the raise of inflation that's hitting all of us, that the seniors are now tapping more into their retirement. And not all seniors have a lot of money put away. So most of them are afraid of losing their retirement money. Now, here are a few reasons why seniors look into the reverse mortgage. They either, one, are equity rich but cash poor, meaning all their money is in the home versus they're having that money in their bank. Secondly, they have a mortgage payment that takes up most of their money, or they have a lot of years left still on their mortgage and they don't want to keep paying for the remaining of their life. A lot of them are still trying to save the home from foreclosure and they can't qualify for refinancing. So I get a lot of people that call in that they're losing their home because they can't afford the monthly mortgage payments anymore. And a traditional traditional loan is just not working for them. But also people are looking to have emergency funds to fall back on for unexpected expenses that come up, like medical bills and repairs on their home. And a lot of them still want to build a better nest egg so they don't outlive their savings. Now, when it comes to the reverse mortgage, it does work differently for each person. There are three typical type of financial situations that clients are in. They're either struggling monthly and they're just getting by and they don't have any savings. Some of them break even every month. They try to put money away, but a lot of them don't have any really much savings. But you do get some of those people that do have a good retirement income. They're able to put money away, but they're still not able to do what they really want to do in their retirement because they're afraid of depleting the money that they've been saving all those years. And that is where the reverse mortgage is an awesome program because it allows them to access that trapped equity in their home. Now, this is how the reverse mortgage works, and this is how it should be explained to your clients. The good part is I've actually worked up a script for you guys to help you as well. So please feel free, again, to stop me at any time if there's any questions you guys have, okay? But really, when it comes to reverse mortgage, it's really just a financial tool that allows the clients to access a portion of the value of the home, but it's not the whole value because the program is not designed to strip them of all their equity. So based on their age and the value of the home is what HUD uses to see how much equity they can access. So the younger they are, the less it gives them versus the older they are. So here's an example. If you have a customer that's between the age of 62 to 65, now most likely they can access about 35 to 40% of the value of the home. Now, if they were 70 to 75 years of age, most likely they'll be able to access between 40 to 45 and so on. Any questions so far just about that part right now that I explained? Okay. Now, when it comes to reverse mortgage, again, there's no monthly mortgage payments required. So they're never required to make any monthly mortgage payments for the remaining of their life, but they can always make payments if they ever wanted to. It puts them in the driver's seat. So I have clients that sometimes want to make mortgage payments on the loan because they don't want to leave a big balance for their kids when they inherit the home. The payments can be whatever they want it to be. There is no set payment. So they are never required to make a payment, but they always can. When it comes to the program, it does require them to always do this. They must continue to pay their property taxes, homeowners insurance, and maintain the home. That is the agreement. Even if the house was paid off in full and they don't owe anything, we all still have to pay property taxes, homeowners insurance, and maintain the home. So that's just like the home being free and clear. When they do the reverse mortgage, title doesn't change. Whatever's on title is how it's going to stay. If they're listed as husband and wife, or if it's in a living trust, that won't change at all. They still decide who's going to inherit the home when they pass away, and whatever funds that is available to them, all of it is 100% tax-free money. Okay, they are never required to claim that money on personal income taxes if they still file. Because I do have clients that they still have some type of side job and they file their personal income taxes and they have a reverse mortgage and they got the money from. You don't put that in your income. It's not a requirement at all. Any questions so far about what I went over on this part? If anybody has a question, please don't hesitate to chime right in. Now, when it comes to Social Security and Medicare, this will not be affected by doing a reverse mortgage because the money is not considered income. There are no prepay penalties on this loan. So that means they can literally, from day one, they can always sell their house at any time if they want to. They can refinance a reverse mortgage again after 12 months if they want to. If the rates drop, then they're going to get more money. They can do that. If they got blessed and won the lottery or received a big inheritance, they can always pay out this loan at any time. And again, they can always make any payments they want to throughout the loan or never. Now, because this program is FHA insured, one, it allows the client to never make a payment, as we talked about. But two, if their home value ever drops below the balance of the mortgage because the market crashed, it will cover that difference for them. So it's kind of like gap insurance on a vehicle. If you ever bought a car and you still make payments on it, they offer you gap insurance that if you ever wreck your car and the insurance doesn't cover it all, the gap insurance will cover that negative for you. That's kind of how it works. Now, when it comes to married couple, there is spouse protection on this program. So if one of the spouses passes away before the other one, this program stays in effect until both of them are no longer on this earth. Okay? Even if one of them is going to be a non-borrowing spouse on the loan, that non-borrowing spouse is still protected on this program. Now, if there's any funds available to the client, which most of the time there always are, there's multiple ways that they can access the money. They can either take it all at one time, leave it, or they can, do a lump sum, which is all at one time. They can do monthly installments to themselves or leave it in a line of credit and access it whenever they want to. Did somebody have a question? I thought I saw.
David.
Yes.
I did have regarding that spouse protection. What about the scenario if one of the spouses is under the age 62?
The good part is when it comes to the program, one of them just has to be 62 years of age. So, and I'm glad you brought that up because I have clients that are 65 years of age. They have someone that they're married to that is 50. So even though this person won't be on the loan because they're not 62, but because they're married, if that person ends up passing away, this person, the living spouse, is still protected and can live in that house for the remaining of their life.
Wow. Okay. Even though they may be 50 years old. Okay.
Yes, correct. Yes. You wouldn't believe that I actually had a client that was 80 years old and his wife was 40 and they had 2 kids. Was there another question? Harry, did you have a question? Or Dave?
I have a question. Oh,
yes.
Go ahead, Harry.
You go. Okay, you go first, Dave.
Okay. So in regard to spouse protection, your thing says until the last spouse leaves this earth. Is it leaves this earth or moves out of the house? What if they leave that house to go into some sort of care? Would that negate the contract?
Correct. Because it's a primary residence, if the only time they'll ever call the loan due is when either they pass away, both of them, or they leave the house, they're not returning back, or they decide to sell the house. So that's the only time they'll ever call the loan due. Harry, did you have a question or was that kind of the same?
No, actually, I was about to ask about the age. You mentioned the age range would affect the LTV that they can, the amount of equity they can take out of the loan. So
right.
Beside the LTV, would the age affect anything else?
Yes. Because they go off the age of the youngest of the two if they're married, that they're going to use the youngest person. So what's available to them could be a lot less versus if they were older. So like, here's an example. Let's say if somebody was 70 years old and their wife was 65 years old, they're going to use a wife's age of 65. So most likely they'll be able to access maybe 40% out of the equity of the home versus getting 45 to 50 if they were 70, because they want to preserve the equity for the youngest person alive. That's why they go off of that.
I see. Got it. Thank you.
No problem.
I have a question.
Yes, miss.
What about the DTI to qualify? Do they have to have like a certain DTI to qualify or not?
You know what? The good thing about the reverse mortgage, this is what they look at to qualify somebody. One, as you know, they're going to go off the age of the person. Then they do go off the income. Now, when they go off the income, it's different than a traditional loan. It's not like it's a big difference when it comes to DTI, because on the reverse mortgage, they just have to show that they make enough to continue to pay taxes, insurance, maintain their home on the program. So where a traditional loan is, it's everything on the credit report and all that kind of stuff. So they have DTI requirements, but this one here on the reverse mortgage, it's still considered somewhat of a DTI, but it's really basically taxes, insurance, and maintaining their home. As long as they make enough income to cover that, then they can qualify. Is there Ryan?
Thank you.
Anytime, miss. Thank you. Ryan or Brian, did you guys have a question?
I did. So it's just pretty much looking at front end DTI then in this case?
When it comes to the credit report, let me tell you what they look at. The good thing is this program is not a FICO score driven program. So they're not seeing if they got good credit scores or not good credit scores. What they're looking at on the credit report, if there's any judgments, liens, or major lates that come up against them in the past 2 to 3 years, and if their property taxes and homeowners insurance has ever been behind or late in the past 2 to 3 years. So even if the customer doesn't have such a great credit, they still can be eligible for the program, but there's just a little bit more hoops to go through. Did that answer your question?
Yes.
Okay, perfect. I see Wayne and Brian's hand is still up.
Yeah, can you hear me?
Yes, Brian.
Okay, so I have two questions. The first
Sure.
question about the interest payment. So you mentioned that the client does not have to pay the mortgage payment. So what about the interest? The interest payment, like is this they have to owe the interest more when when they sell the home, the interest is increasing eventually?
When it comes to, let's say, again, to answer that question is this. Now, when a customer has a reverse mortgage, of course, there's interest that accrues and it's compound interest. Okay, so interest does accrue every month. If the customer decides never to make a payment towards that interest, whatever's owed on that interest will go to the back of the balance. So slowly, their balance can grow because they're deciding to make no payments. They're literally in charge of their loan. The bank is not dictating to them that they're required to make payments. So any payments that they make will go to the balance. If they decide to make nothing, then it just gets added to the back of the loan.
Okay, I see. And the second question I have that's for the property value. So they didn't make any payment during the lifespan of the loan, the reverse mortgage.
Uh-huh.
But during the time that the property value maybe is getting lower than the balance of the mortgage. So what happened is that they will be under the water. Yeah.
Well, here's a good thing. And I'm glad you brought that up because it's going to come out. Well, here's about the interest compound here, right? Like you're talking about first. So I did put it in here that the client's going to receive a monthly installment. Well, they're going to receive reverse mortgage monthly mailer every month, the statement. And the statement's going to show them what their balance is, interest rate is, and interest that accrues. So whatever that interest that accrues, if they don't make a payment, it goes to the back of the balance. Now, when it comes to the value of the home that you're talking about, you're saying, now, let's just say the property goes upside down. So if you see here on the third bullet, FHA insured. So what it means is this: if the value ever drops below the balance of the mortgage, like you said, it goes upside down and they're negative, right? It will cover that negative difference for them. They can never owe more than what the house is worth. So here's another great example. Let's say your parents passed away and you inherit the home. Now, they owe $400,000 on the reverse mortgage. The market crashed. And let's say where they live at, the values dropped down to 300, but they owe 400,000. You as an heir, if you decide you want to keep that home, you only have to pay off the current market value of 300,000, not the 400,000. Because it's FHA insured, it covers that negative.
Oh, great. Okay.
Yeah.
Okay.
So it's a big benefit to not just family members, but also, to the parents, because they can never owe more than what the house is worth ever.
Great. Got it. Okay. Thank you
Wayne,
so
did-
much.
yes.
Hi, can I ask, since this is a FHA insured loan, is there any MI on the loan?
They have what they call mortgage insurance premium. It's not PMI. It's mortgage insurance premium, which is the FHA insured. So it doesn't mean it's like the regular insurance that people have on their home. So you're going to see on there, and I'm going to show you guys what it looks like of the MIP. Okay. Wayne, did you have a question?
Yeah, real quickly. I know you got to get through this.
No, please.
But with high tech, are you guys doing this RM loan as purchase as well as refi?
Yes.
Okay.
Some people
And-
can, if you want to do a reverse mortgage purchase, you can do that. The only difference is it does require a large down payment. So as an example, if a customer is 62 years of age and they want to buy a house, they would most likely be required to put down 60%. The lender will cover the 40,
Yeah.
right?
Makes
So
sense.
the older you are, the more the lender will cover. So if they were 75, then they just put down 50%. That kind of an example. It actually works really good for people that end up downsizing. There's a lot of people that have their house, it's too big, and they're going, yeah, let me just sell it. They still make a lot of money off of it. So what the reverse mortgage will do for them is that even though they put down 50%, they're still keeping the other 50% of their proceeds to put away. So they don't use all the money.
Yeah. Also, part two, real quick, with your guys' overlays or what have you, if a current customer who has a forward mortgage right now, but let's say they've got maybe 30-day lates on their mortgage in the last year, is that bump them out of this program potentially?
No, the good thing is this. Again, because of the equity of the home, even if they're behind or late and stuff like that, they can still qualify, but then the reverse mortgage might want what they call is a LISA, life expectancy set aside. What that means is this. They'll basically say, well, since the customer has been late all the time with everything, and we don't want them to be late on their property taxes, homeowners insurance, that we're going to require to pay that in the reverse mortgage for so many years. So when they do that, it takes away from some of the money that they're going to receive on the reverse mortgage. It puts it in a set aside escrow.
Makes sense. Thank you.
No problem. Anybody else has a question so far before I move on? Okay. Like I said, I just went over this and he asked this question about interest accrues on a loan. So we all know that if they don't make any payments, the interest will go to the back of the balance. Now, here are the most common myths that come up on a reverse mortgage. And you're going to hear this from your clients. They're literally going to tell you guys to this. They go, well, does the bank own my home? No. You always own your home. It's the same as a regular loan. When you get a loan, refinance, or purchase, you're on title. You own your home. Next thing is normally asked, can I lose my home? The only way a borrower can ever lose their home if they literally stop making property tax payments, homeowners insurance, or no longer live at the house. Because that's the agreement when it comes to reverse mortgage. You have to continue paying that. Now, nobody wants to foreclose on a senior. So just to let you know that if something like this does happen, because the county is going to let us know as a lender, hey, we haven't received our property taxes and stuff. We would contact the borrower, find out what the situation is, and see if we can help remedy that by either helping them pay for it, add a little bit to the loan, refinance, or something. But we'll always try to find a way to help them out and find out what the situation is. But again, the only way a client can ever lose their home and that would be considered a breach of contract. They stop paying property taxes, they stop paying their homeowners insurance, or they don't live there anymore because it's for primary use. Can this affect my Social Security or Medicare benefits? No, because it's not considered income what they receive. So they're not going to lose that. Do they have to pay taxes on the money they receive? No, because all the money is 100% tax-free.
Do you have a way of emailing each of us who are on here on this slideshow presentation?
Yes, I'll definitely send that to you guys, but also I'm going to send you guys a script for just reverse mortgages that you can literally be on a call with your client and you can read it verbatim if you wanted to. And it will have all this information of how to explain it, like literally, okay? Because I want to help you guys. And if I need to be on the phone with you guys, please don't hesitate to even ask me to be on the phone, okay? Ryan, you have a question?
Yeah, so regarding those payments for taxes and insurance, like you said, I'm not missing it. Is there a way, I don't know if this is the case for a reverse mortgage, to like escrow it so they get less net to them and then escrow it into some sort of an account so it's paid for by that reverse mortgage agency in a case?
Yeah, so it works like this. Let's say your client doesn't have such a great credit and we say, you know what, we have to add taxes and insurance in the loan. Let's say they owe about $7,000 for taxes and insurance every year. And the program will require them to put 5 years of that into escrow. So whatever money they receive, we're going to subtract 5 years of that, which would be about $35,000. So let's say if they were getting 100 grand, they're now going to get $65,000 only because 35 of that will go in there to pay taxes and insurance for the next 5 years.
So 5 years up front, right? Deducted from the overall.
Correct. If that's part of it, if they only want 5. Now, sometimes I've seen it more than 5. I've seen it 10. I've seen it actually go 20 years. It really just depends on how old they are and how much they pay on their property tax and home insurance every year. Anybody else have a question regarding that, either about property taxes, home insurance on No?
I have a question in regard to, I have a lot of financial planners, and I know you said you were going to give us a script to talk to homeowners with, but in a down market, I think it's wise to use your home's equity instead of, say, your 401k.
Correct.
You'll be a lot further ahead in the long run. Do you have
Right.
any projections or marketing material that we could show to financial planners?
I do have marketing stuff for you guys that you guys can probably use for financial planners. Let me tell you, as a loan officer, this is who I actually reached out to go outside the box. I literally contact tax preparers and financial advisors directly. Like I'll go online, I'll find out in my city where these people are located at, give them a call, and then I'll let them know about, myself, how the program works, and if they're willing to work with me, that I also can refer them business, because there's going to be people that that might need a tax preparer or a financial advisor. Remember, financial advisors and tax preparers, just like everybody else, they want to know what's in it for them, right? So if you guys can correlate that way, man, it works awesomely, because I've done that many times. I get a lot of business from financial advisors because they want to get more money to invest for their clients. Dean, did you have a question?
Yeah, hello. Going back to what Ryan was saying. So you said that it's only when their credit score is like a little bit lower than they require like 5-year upfront tax and insurance.
It's not their credit score. It's not their credit score. If they have a lot of derogatories, like in other words, they're late behind on everything for the past 2 to 3 years.
Okay. So what if they are like a good candidate and everything is clean, and then is that an option for them to do that?
Yes, they can still, there's two things they can do. They can either, we want that as an option to add tax and insurance into it, or if they have credit that we can't get around, like there's no explanation of what happened and we have to go that route to get them eligible, then we have to do that. But a client can choose that option if they want to.
Okay, got it. Thanks.
Perfect. No worries.
Hi, I have a question.
Yes.
My question is, and you may have said this and I may have missed it.
It's okay.
I know you said on FHA insured loans that if the value is, if they have negative equity or they owe more than the house is worth, does that work the same for conventional loans?
No, because the program's only FHA alone.
Oh, FHA. Okay, I'm sorry. I'm a new Ella. Okay.
No, it's okay.
Okay, gotcha.
No, these are all great questions, and thank you guys for asking these, because I could tell everybody, you don't know until you ask, right? So, but anybody else has any other question before I move forward?
Can you clear on when you say that if they don't pay tax and insurance, you mean like the bank would take over the house completely, or they sell and pay, if the market is more, would pay them back, or how, like they completely lost the house?
Okay, can you kind of clarify, because I'm kind of getting different information.
Yes. So I kind of didn't really understand say that if they don't pay the property tax or insurance, they will lose or no longer live there, or lose the house.
Okay,
like,
so you're seeing this right here. Okay. Yeah. Could I lose my home, right?
Yes.
The only way, remember, when you do a reverse mortgage, the contract is this. If you do the reverse mortgage and you get it done, the agreement is you have to continue to pay taxes, homeowners insurance, and maintain the home. That is the agreement, right? Oops. So if for some reason they stop paying it, right?
Okay. Yes.
And no one can get a hold of them, everybody's trying to call them, but they're not answering, and they're ignoring letters that they're receiving, then foreclosure proceedings can happen.
Oh, okay. Okay, got it.
You know what I mean? So it only really comes down to, like I said, if they're just totally not doing it, they're just not doing it, wherever the reason is. Now, this is what we do as a lender. The county is going to let us know that those no payments are being made. We would reach out to the client by a phone call. We'll send letters, whatever deal is, to try to get them on the phone to find out, hey, what's going on? What's causing you not to make these payments? Maybe we can help you. We do not want to foreclose on any seniors. We always want to help them as much as we can. But let's just say they're just ignoring everybody. They're not calling nobody. They're not answering nobody. We don't know if they're alive or not, or they moved out of the house. Because that's the only reason why they most likely will stop paying. They either passed away or they moved out and they just didn't let nobody know. But again, yeah.
Okay, thank you.
No problem.
And David, this is a HECM loan. Is that what you're talking about?
Yes. And HECM is a home equity conversion mortgage, AKA reverse mortgage.
Yes, and so then commissions are paid on the appraised value, not the initial draw?
No, the commissions are paid totally. It's not like that. Matter of fact, I'm going to go over that too. I'm going to show you guys about that. Okay.
Okay.
All right. Perfect. Again, this comes up a lot. The bank will take my home from my heirs. No, that doesn't happen. Again, whoever inherits a home, they decide they want to keep the home or sell it. Now, we did talk about this a little bit too, because there was a question. So if the heirs want to keep the home, this is what happens. They must pay off the existing reverse mortgage by either getting their own mortgage. Basically, they're going to refinance the loan into their own name, or if they have the money to actually pay it off in full. But if they don't want to keep the house, they just want to sell it. Well, again, yeah, they're going to sell it for top dollar, right? And all the money that they receive, it's going to pay out the existing loan, and whatever's left over is all going to go to them. Any question about that at all? Okay.
Yeah, David, can you back up on that slide, please?
Sure.
The bullet point number 1, if those particular heirs, let's say, are in their 30s or 40s, they can't qualify for refinancing the previous reverse mortgage, right? So
it doesn't have to be a reverse mortgage. I mean, just a general traditional FHA or conventional loan.
Forward. Okay.
Yeah.
That's what I mean. Yeah.
New mortgage.
Exactly. A new mortgage, but it was going to be a forward because they're not of age yet. Okay.
Correct.
Thank you.
Yes. I should have said forward, but thank you for saying that, Wayne.
No more. I'm just clarifying. Thank you.
No, it's perfect. Thank you. Now, excuse me. Now, when it comes to reverse mortgage versus traditional, again, here is the benefit. And this works for people that still want to continue making mortgage payments even though they had the option not to. Because I do get a lot of clients that still want to pay. Now, when it comes to reverse mortgage, they make payments if they want to or not. The flexibility is they pay whatever they want. There is no such thing as a standard payment. So if they want to pay less than the interest or above it, it's up to them. And they can do imperfect payments. Basically means they can pay anytime they want to, when they want to. I have a customer that normally makes payments from January through March and then doesn't make any payments for the rest of the year. It doesn't mean they're going to lose their home at all because they're not required to. But as you know, on a forward loan, you have to make mortgage payments. You cannot make less than what the payments are. There's no flexibility. And if you miss any payments, what's going to happen? Notice a default, get into foreclosures. So there is a big benefit for people to do a reverse mortgage, even if they want to continue making payments. Now, here is what the programs are available on a reverse mortgage. They have 3 options. The first 2 are adjustable loans, and they have a fix. Now, when it comes to the adjustable loan, the CMT, right? That is, consistent mutual treasury, which we use now for the US. We used to use a LIBOR, but HUD doesn't use that no more. So now we're just using our own, right? Now, when you see the number 5 or the number 10 on those adjustable, that means whatever interest rates that they were approved for in the beginning, that's their cap rate that it can go up to. It can go up 5 points or it can go up 10 points. So as an example, if someone has an interest rate of 5, and let's say the rates start jumping up like they have right now, that the maximum on a monthly 5, if their interest rate was 5%, it can only go to a max cap of 10. That's 5 points up. If they decide to do the monthly 10, then that 5 can go maximum to 15. It just means their cap rate on an adjustable, because every adjustable has a cap rate. Any question about that right now?
Yeah, David, maybe this is for another day, but can you identify why a particular customer would want to take a monthly of 5 versus a monthly of 10? Is there huge benefits or otherwise?
Now, that's a great question, and there was a benefit. The benefit was you were able to access more money on increment that goes up 10 versus 5. But because of the raise of rates right now, they're actually evened out. So I wouldn't even offer a monthly 10 to anybody because it's going to be the same amount.
Like short-term versus long-term rate in interest rates because of what the feds are doing and things like that. Is that right?
Correct. And that's a great question you asked. So,
okay.
Now, When it comes to the reverse mortgage, there are 3 costs that are involved into the loan. Okay. Now, these 3 costs I'm going to go over, they are included in the loan. So they all get financed into loans. They're not out of pocket to the client. The first one is what someone brought up, if there's MIP, if there's a mortgage insurance. Well, it is, but it's called mortgage insurance premium, which is the FHA insured. That is the one that they don't have to make a payment. They ever go upside down, it covers it for them. But it also covers this too. If a client decides to do a line of credit, it makes sure that that line of credit will always be available to them, regardless if the market is up and down. It's not based off the market. Now, it is a big hit charge. HUD charges 2% of whatever the value of the home is. So if the house is worth $500,000 value, HUD's going to charge them 10 grand. Okay. Now, the second one, of course, is going to be your guys' cost, your origination. I always have it at 6,000 that you guys will receive, unless you guys decide you want to bring that down. But normally it's $6,000, which you guys receive in commission. And the last cost is the closing cost, escrow, title, all your necessary documents and disclosures. So these 3 costs will actually be put into the loan, and it will not be collected until the end, which is for the clients pass away, sell their house, or decide to move out and no longer be there. Okay. But you guys get all your money right there and then. Any question about this before I go on the next slide to show you guys how it really looks? Okay. Now, here are the 2 out-of-pockets that clients will always pay on a reverse mortgage. Everybody that does a reverse mortgage has to go through a counseling that's done over the phone. Okay. It's a requirement by HUD. And the reason why HUD requires it is because back before 2010, people were complaining to HUD that after they had the reverse mortgage, nobody told them about certain things about the program. So HUD says, we're going to cut that. He say, she say. We're going to make everybody go through counseling, and you get them a certificate. So if they come back saying they didn't know, they'll be like, nope, you took a class. So they normally charge between $120 to $150. Okay? As a lender, we can't pay for that, and you guys cannot either. HUD requires the borrower to pay for it. But I do know that certain counseling companies will allow them to pay it 30, 40, 50 days later. So they will invoice it to us. When the loan closes, we can pay it out of the loan when the loan closes, if the client doesn't have the money for it. Right? That's an option that some counseling companies have. And the last cost is going to be the appraisal cost, which is normally $550 to $650. Okay? Any question about this part? Now, I do want to bring this up because this has happened. I had a customer call me up that the broker's office called me up and said they want the client to finance the appraisal fee in the loan. Well, let me tell you what happens, because you guys are wholesale. We would require that fee to be paid up front from the broker, since they want to finance it into the loan, the broker's office, because if the loan doesn't close for whatever reason, they didn't qualify or they decide to cancel, someone's responsible for that fee. We will not reimburse anybody for that fee. So, as you know, when a client is no longer doing anything, you know how hard it is to collect from them, right? They're like, well, I didn't do my loan, you're not gonna get my money. So I don't recommend trying, to finance the appraisal into the cost, because that's going to be a cost upfront from you guys first before anything from the client. Anybody have a question regarding that? I only brought that up because it has happened.
So it is good advice, of course, to get the customer's credit card that we're doing the appraisal for.
Right. So,
Yeah.
And all it will be actually a link. The appraisal company will actually email the client directly, and then they can pay for it right online.
Right.
Right. So you guys don't have to worry about all that stuff. Now, when I do the proposals for you guys, there are 3 things that the client will receive. And here they are in front of you guys, which is going to be the comparison page, the amortization schedule, and the total loan cost. And I will always go over this with you guys every time. And I can always go over it with your client if you guys ever want me to directly. Okay. Until you guys are comfortable explaining it, or you guys tell me you don't want me to do it anymore, you guys got that handled. But let me explain each page. Every time I do a reverse mortgage for a customer, this is what I put on here. I literally write this stuff in here. The reason why, the customers don't know our lingo. They don't know what these certain things mean. So when you're doing this is literally how I go over it with them. I'll go over saying, here's your interest rate. I highlighted in the top that the interest rate right now is at a 7.620 interest rate. Their cap on the loan, because they're doing a monthly 5, it's adjustable loan, that the max it can go up to is 12.620 for the entire life of the loan. So if you go 7.625 and you add the 5%, that's giving you the 12 point. That's what I'm saying. There's a 5% and there's a 10, right? Also, this client has a line of credit, which you can see down here below. That line of credit actually has a growth rate built in it. So that money that sits in a line of credit will actually grow for them at a 8.120%. That's pretty big. So this client is going to take out $31,760 upfront, and the remaining $61,000 is going to be in a line of credit. So if you go 61,000, 64.45, and you times it by 8.120%, next year it's going to add in another almost $5,000 to it. So next year they'll have access to 66,000 versus 61. Now, this house is going for 800,000 value. Out of the $800,000 value, this person is eligible to take out $317,600 from the value of the home. That's what they got approved for. And here are the 3 costs involving to the loan. The first cost is the FHA insured. 2% of that is 16 grand. What you guys get paid, the $6,000 for origination, what the closing cost would be on this loan. So these 3 here will literally be financed into the loan and collected at the end. These numbers get subtracted from the 317. So once you subtract it, there's $292,824.55 left over. Now this person has a mortgage, so we're going to subtract 200,000 from that. Once we do that, what they're going to have available to them is $92,824.45. Now, when it comes to adjustable loans, HUD does make this broken down into 2 portions. They can take out the max the first year of $31,760, which this one's taken out, and the remaining $61,064.45, they can access that 12 months later. Here's HUD's reasoning. The reason why they don't let them take all of this up front, because they want to make sure that the client has money next year to pay for property taxes and home insurance and don't default on the loan. That's the reason why they do this. On the second column, it's the same thing. CM monthly 10. If you notice, all the numbers are the same. It doesn't benefit them from doing a 10 right now. And then the last one is their fix at a 6.430 fix. Here is the difference between the fix and the adjustable. The adjustable will give you more money. The fix, even though it says $92,000 here, HUD is only going to let them take out the lump sum of $31,760 only, and that's it. They don't get the $92,824 like they do on the adjustable. So just because you see it here doesn't mean it's available to the customer. This is what they're going to receive, and that's the reason why most of them go the adjustable way. Harry, did you have a question?
I just want to confirm on the FHA insured cost. So you say it is 2% of the home value, right?
That is correct.
Okay, yeah. The cost to loan factory will be fixed at 6,000.
Yeah, we always have the origination at 6,000 unless you guys decide you want to lower that.
Okay, if that is the max cap, or we can earn more than that
Correct.
6,000.
No, that's the max cap on.
Okay, so the next and the final question I have is the portion of the cash available as funding. So I'm trying to divide that with the available fund to the client. So how do we determine that?
This is automatically determined for you. Every time I do a proposal, I can tell you exactly the max they can take out that first year. And it's up to the client if they want to take that money out. They're not required to take it out.
Got you. Is there any number that we can, predetermine when we do this calculation to the borrowers so they can tell how much they're going to take out at cash?
You know what? The hard part is because the program goes off people's ages, and HUD has been changing how people can access money, because it used to be set and then they change it once a year. But lately, because the rates are going up, every time an interest rate goes up, less money is available to the client. The lower the rate, the more money. So
I see.
now I want you to look at this up on top. Do you guys see where it says the margin right here?
Mhm.
2.5. Now you guys can always adjust that margin down to like maybe a 1.625. If you do that, then that means this interest rate will drop. And when that interest rate drops, they're going to get more money. Okay.
So how does that affect the loan? I mean,
What it affect you guys where it comes to is that on the loan, when it comes to the back end rebates is where it affects you, not what you guys get up front. So like the rebates on the back end can be 1%, or it can even go up to almost 6% on the back end. So those are the rebates on the back of the loan, which I'm going to show you guys too. Okay.
Good, great, because I was wondering if that 6,000 was set in stone, that's all we make. So
Yeah,
thank you
yeah.
for sharing that.
Not a problem at all. But it's a great question. And thank you, Harry, for asking that question. Did you have another question regarding that, Harry, or did I answer your question?
yeah, I'm good.
Okay. Din, do you have another question?
Yeah, try to see. So this is based on the top it say 1953. So this is the 70-year-old client, right?
Yes.
And we go through this whole thing and they net only 31,000. But because that's because they owe the mortgage 200,000. If they paid off free and clear, they could get more, right? 200.
Correct. But they're netting 92,000. You see what says available amount to you? 92,000.
But I'm talking about the fixed one, the fixed rate.
The fixed rate. Yeah, the fixed rate, they're only getting 31,000 net. Correct.
But if they paid off their current, or if they own the house free and clear, this will
This number will jump. Yes, this number will jump.
Add 200 to it.
It just depends, but yeah, it could be. Until I run a calculation, but yeah, it can
Okay.
be up to that high. But remember, when you look at both of them, so like, let's just say this one, like I said, let's just say they didn't have that mortgage there, right? And this says 292,000, right? So whatever the amount that they can take out the first year is usually the same amount here and no more on the fix.
Gotcha.
So as you know here, look at the difference here. There's like a $60,000 difference.
Yeah. So does the people most of the time they take the lump sum of 31, or they take it in like monthly payment of like spread out through?
Most
like, 12
people
months?
do this, to be honest. They mostly like the line of credit versus getting monthly installments or taking some of the money out. Like they'll take some of the money out and leave the rest in the line of credit because the line of credit's going to grow for them. Like on this one here, if they didn't touch it for 1 year, it's going to add another $6,000 in their line of credit. So they have 66,000, right? So, and then let's say again, they go, well, I still don't need the money. And they left it in there for another year. So now the 66,000 is times by the 8.2%. Now they're going to get another $5,000 added again next year. So they can literally grow and grow. And I'm going to show you guys on the next page, okay, of how that works.
All right.
Any other questions before I go to the next page? No? Okay. So here is what I wanted to show you guys, the amortization schedule. Here's the third page that the client gets. Again, this is what I fill out and I give to the client. On the top portion is going to tell them again what their rate is, what the value of the home is, what they're eligible for, what they took out the first year, what we're paying off, and what their line of credit is right now. Now, this is going out the person's age of 70, and it goes all the way down until they hit 99. If they go to live beyond 99, I mean, there's another table, but this one just stops at 99, okay? So it doesn't mean 99 and they call the loan due. Yeah. So here, you can see here what the interest rate that they're using to calculate on them, what the interest is accruing for the whole year. This is a whole year. So you can divide that by 12, and that's what they're adding to their loan every year, every month. Here is the actual balance that they're going to owe every year, so they can see future. Here's their line of credit. If that 61,000 sits in there for 5 years, it's going to be 86,000. If they let it sit there for 10 years, it's 121,000. Now, this person had a mortgage payment. They were paying $2,000 a month, and they had 20 years left. What I showed them here, that here's their mortgage payment savings per year. So even though now that $2,000 they're putting back into their pocket versus giving it to the bank. So within a 10-year period, they will be saving $240,000 back to them versus giving it to the bank, not including what they got in their line of credit. So now this person goes, wow, what a big benefit. I don't have to be paying 20 more years of this mortgage payment, because by the time they give them their last mortgage payment, they're going to be set almost 90 years old plus. Nobody wants to be paying for their loan for the remaining of their life. And we don't even know if we're even going to live that long. So here they can take the advantage of saving their mortgage payments, how much they're going to be saving just within a 10-year period, even though they owe 20, how their line of credit's going to grow. We use a 4% value growth. Certain areas are at a 7, but we're just using a 4% to be conservative. So, and we're showing them this is what the house should be worth in these years if the market trend stays where it's at. And if you don't take any more money and you only owe this, when time you sell your house, you still have all this money left over to yourself, because here's your balance. Balance here, what the house should be worth, what you should receive after you pay off the reverse mortgage.
So is it safe to say, David, that the only really offset is the loan balance increases yearly?
Correct.
Is that wrong? Okay.
No, the loan, yeah, you're right. Well, you know what? When you get the reverse mortgage statement, it's going to show it on a monthly basis. So you're going to see it literally creep a little bit here and there. But this is just really good to show them as a whole, right? So if somebody goes, well, I mean, really, is my interest going to be that much every month or every year? So if you divide that by 12, that's $1,400 a month of interest is accruing on their loan right now. So they can see the growth, but they can also see the benefit of how much they're getting, how much they're saving, and how much equity there. All right.
Perfect.
Got it. Din, do you have another question?
Yeah, I'm trying to understand this. Okay, so if I'm like 99 years old, the loan balance is 2 million. Is that right? So does that mean that I'm owing 2 million?
Yeah, that means you owe 2 million, right?
Oh Lord.
Right.
So,
You
so
owe
that
two-
if
But
my
listen,
kid inherited,
yeah.
they're gonna have to pay that 2
No,
million?
but wait, listen, you owe 2 million, right?
Yeah.
But the value of your home at that time is worth 2.5, almost 2.6 million. So even if your family gets it and they pay off that loan, they're still going to have over $500,000 going to them. But there's no guarantee any of us are going to live 99.
Correct. Yeah, I understand. Okay.
But let me tell you also this too, keep this in mind. Just because they got the reverse mortgage, let me tell you, most people, as you know, in just doing regular forward mortgages, people end up refinancing 3, 5, 6 years later down the line. This customer can refinance anytime they want to. So just because it's going 99 years for them, guess what? Let's say the rates drop. They refinanced it because they want to get the better rate. Well, all these numbers are going to go lower. You see what I mean?
Yeah, I see what you mean.
Yeah. That's a great question, Ding Dong. Thank you. That was a great question. Any other questions so far before I move on to the next page? Okay, perfect. Now, here's the last page that they're going to get. Now, this page is called the total annual loan cost. It's really just the short form of the first page. Again, the value of the home, how much they taken out in the beginning, when they access the money the last 12 months later. And this is just the costs that are involved into the loan. Now, here I want you to look at this total annual loan cost rate. This here is just an example. It does not mean this is what the client's rates are going to be. This is just saying that this is an example. If they only had the loan for 2 years, it's like, and they paid it off, it's like the interest rate would have been at 13%. The longer they have it, the lower the rate would go. And again, this is just an example. So how I always explain it is like this. If I bought a suit for $100 and I used it once, my value of it went down to $75 because I used it. If I use it twice, it went down to 50 and so on. So it just means the same thing. The longer they have the loan, the lesser rate that they normally would have on it. It's just an example, and I just want to tell you guys that because when clients get this, first thing they tell you is, hey, you told me my interest rate was a 7. This one says 13.592. It's just an example. And
What is the expected rate? I saw that on the last page, I think.
right. Now, here it is on the first page. Now, let me tell you what the expected rate is. The one that says 6.4 10-0. This is what HUD projects the rate should drop down to in the future. So they use this number to see how much the client is eligible for. That's all it is. It's really made for eligibility, not really meant to be like, this is what the rates are going to actually be, but they'll calculate everything off of that. So when you look at this part here, look at the interest rate, 6.40. Even though this rate is supposed to be 7.625, they project in the future it's going to drop. Right now, of course, the rates are where they are. But on the average, in the past 20 years or so, we've been averaging between 4 to 5%. So it's just a projection. Did that answer your question?
Yes.
Okay, thank you. Now let's get to the most important part, right? How do you get paid on the reverse mortgage? Now when we look at the rate, the interest rate and stuff on the rate sheet, it's just a little bit different than how you look at a traditional loan. Okay, but it's easy, and I'm going to use the same proposal to show you how it all calculates. Okay, so here's the proposal here. So when you look at the proposal, I just want you guys to focus on two items. One, initial loan balance here in the bottom. You're going to get this number, and you're going to divide it into the principal limit or the eligible amount of $317,600, right? And here's the reason why. Okay, I just blew it up. When we look at the rate sheet, we go off of utilization, and I'm going to show you how that works. But again, here's the formula. This divided into this gets you this, right? So you write down that number. Again, now I'm just going to let you guys know too that every time you guys send me something to give you guys a proposal on or qualify, I will actually put the calculation for you in an email all the time. So when you're looking at the rate sheet, like the one we just did right now, I used a margin at 2.5. Now remember, the utilization is 80% plus. So we go off here, the blue section, blue column. So you're going to go to 80% here, between 80 to 90, because that's what the total is, 80 point plus. Now, with the 2.5 margin, the back end rebate is at a 6.25. You can go all the way down to a 1.625 if you want to. It will bring the interest rate down to a 6.665, and the rebate will drop down to just 0.625. Okay, so that's why when you go this and this will give you that percentage to give you the column where to look at. Now, once you get that number, all you're going to do now is get the balance, what the balance is. You're going to times it now by the rebate of the 6.25, which means the back end will get $16,000. That's not including your $6,000 origination. So when you add it all together, you're getting a total of $22,000 that you get on commission. So you guys can literally bring it down if you don't want to hit them that hard, or you bring it down because you're in competition, right? Because, sometimes you get people that shop. So if they're shopping you and they're like, no, the rate's too high, or I don't want this, or whatever deal is, you know that you can always work it down if you needed to. Any question about that part so far?
Yeah, I've got a question.
Sure.
So if the home is free and clear and they decide they just want to take a line of credit
Mhm.
and they don't want to pull any money out, so there would be no rebate, right?
Well, what it would be is this. There'll be a rebate. So like, let's say this one here, let's say they don't have a balance. They have a total of $292,000, right? Thousand available to them. Now, what it would be is whatever this cost is actually going to start their balance, because all these get financed into the loan. So now you got to go, okay, let's say the starting balance is going to be 30 grand, right? As an example, because that's just the cost of the loan. So if you divide that into the 317,600, then the percentage is like closer to 10, like 9 or 10. So you're going to come here and look at these ones right here, and then whatever the margin is going to be. Because look at the back end, 13, right? So if it's 30,000 times 13%, that's about almost 4 grand on the back end. And that's still not including the 6,000 you're charging up front. So now you're making a total of about 10,000. And that's on a small loan.
Plus, it would be even more than that, because if it was free and clear, that 300,000 available would be even higher, right?
No, because this is going off the age of the person, regardless if they have a mortgage or no mortgage. So the person that's 70 years of
Oh.
age, out of 800,000, they're allowing them to use 317,000.
Gotcha.
That's a great question though. Man, you guys are on the ball. I love your questions.
These, what we make, is that also hidden like correspondent? Like we don't have to show it to the customer or what?
You know what? I need to double check on it. I don't believe it does show up like that. I think it only shows up you guys' the upfront cost.
Okay.
But I'll double check on that and I can get back to you on it. But I believe that's all what it shows.
Also, sir, do you have anything, do you have a marketing department, I'm assuming, that puts on different trainings as far as how to capture these seniors and go after them?
We do have like a marketing training for that, but I can show you guys exactly what marketing tools will be available to you guys anyways. So a lot of it will be social media ones, and a lot of them will be actual flyers that will actually be done already. You guys to put your logo and your name.
Cool.
And we also got a pamphlet, reverse mortgage booklet, that you guys put your logo and your name that you can give to your clients.
Awesome. I sent you an email. Whenever you can email me back in regarding any logins that are needed.
You got it. You guys got it.
Thanks.
Now, here's how to qualify somebody. Okay, it's easy. One, as you know, they got to be at least 62, if married, at least one of them. It's got to be their primary residence. We don't do investments or second homes or anything like that. Okay. Now, if someone says, well, I'm going to move to my second home to make it my primary and rent this one out, they got to have a justification too. They have to write a little LOE saying, well, the reason why I'm downsizing, or it's bigger or closer to family or whatever. They have to have equity in the home. And I always use 60% because 50% is a little tough, but I always use 60%. They have to have the ability to pay taxes, home insurance, and maintain their home. And like we talked about earlier, this program is not FICO score driven. So regardless if they have good credit or bad credit, they can still qualify for the loan. Now, when you get a lead and you have somebody that's looking into the reverse mortgage, you can call me or send me an email, and these are the 5 items I just need. The name of their client can be the last name, so I know how to reference it. If they're married, give me both ages, date of birth, but if they're not, just give me that one. Zip code, what property type it is, what you believe the value of the home is, or what they believe the value of the home is, and if they have a mortgage balance or if it's free and clear. Any questions so far, just about anything that I went over? Everybody good?
I have a questions about the cash available to the borrower.
Okay.
So are they able to get all at once, or can they get every month, like a fixed amount for monthly?
When it comes to the cash out available, and when it comes to the fixed loan, they can take all that money up front. On an adjustable loan, they do break it up into 2 portions. Okay. And what was your other question regarding that?
My question is, if they have a choice that able to get cash at once,
Oh, okay. Right.
or able to get a fixed amount like monthly.
Right. This is how it is right here. So see right here on the bottom, it says multiple ways they can access money. So they can take it all in a lump sum. They can break it down into monthly installments to themselves. So let's say they want monthly installments. This is what they say. Hey, you know what? Out of the money that I'm receiving, I want you guys to automatically send me $1,000 every month. And it can be set up that way. We'll send them $1,000 every month until their money runs out. Or they just leave it in a line of credit and then they decide to take out whenever they want to take it out.
That's great. Thank you.
No, anytime, miss. Any other questions? Oh, so there was a question here that says max loan amount. Does it vary by county or state as it is in an FHA loan? No, it's all the same across the board. It doesn't mean that whatever state they're in or county that it's going to lower it down to them. It's pretty much the same across the board. Any other questions that anybody might have? Okay. Now, again, I will always do a one-on-one training with you guys as well. So if you guys ever want to talk to me and you want me to show you guys something or how to sell it, let me know. I will be sending you guys an actual script that I've worked on that I've used a lot. And this script literally has helped me do high conversion when it comes to reverse mortgage. All you guys have to do, send me an email if you guys want me to send you that script, and I'll send it to you guys directly so you guys will have it. You guys can change it, manipulate it, whatever you want to do to make it fit your need. but you can just follow the flow of it and it will literally pretty much answer 90 plus of any questions that a client might have before they even ask you a question. Okay. And
Thank you very much, David. Really appreciate it.
no, not a problem, you guys. Again, I'm here for you guys. Do not hesitate to call me Monday through Sunday. Like you guys, look, man, we have to be available all the time, right? That's how how it goes. But anything you need, please do not hesitate to give me a call or shoot me an email. Thank you
Cool.
guys so much. I really appreciate your time. You guys are really awesome. I appreciate the questions you guys asked.
Thank you.
Thanks,
Take care.
David. Yeah.